Every day, thousands of aspiring traders open their laptops believing they've found the shortcut to financial freedom. Social media is filled with screenshots of massive gains, luxury lifestyles, and bold claims that the US stock market is an ATM for those who know the system. But behind the highlight reels lies a harsher reality. Most day traders lose money, and many lose it fast. The fast-paced world of intraday trading promises excitement and independence, yet it quietly punishes overconfidence, poor risk management, and emotional decisions. So why do so many intelligent, determined people fail in one of the world's most liquid markets? The answer may surprise you.
Day trading in the US market is often portrayed as a fast track to financial independence. With access to advanced trading platforms, zero-commission brokers, and real-time market data, it has never been easier to enter the world of short-term trading. However, statistics and real-world experience reveal a sobering truth. The majority of day traders consistently lose money over time. This article explores the core reasons behind that failure, from unrealistic expectations and emotional decision-making to poor risk management and lack of a tested strategy. Many traders underestimate the discipline required to succeed. The structure of the US market itself, including high competition, institutional dominance, and strict regulations, also plays a critical role. By breaking down the psychological, strategic, and structural challenges of day trading, this guide aims to provide clarity. Understanding why most traders fail is the first step toward avoiding the same costly mistakes and approaching the market with realism and preparation. For many aspiring traders, day trading represents freedom, excitement, and the promise of quick profits. The idea of earning substantial income from a laptop, whether at home or on the go, appeals to those seeking independence from traditional 9-to-5 jobs. Social media amplifies this dream, with influencers posting screenshots of impressive gains, luxury purchases, and extravagant lifestyles, giving the impression that success in the stock market is immediate and achievable for anyone. This vision is fueled by the accessibility of the US stock market, with online brokerages offering zero-commission trades, real-time quotes, and advanced charting tools. Entering the market has never been easier. Educational content, webinars, and trading communities further encourage newcomers to believe that with enough determination or the right strategy, they can beat the market. However, the dream often overlooks the harsh realities of day trading. Markets are highly competitive, dominated by institutional traders with advanced algorithms and deep resources. The illusion of fast wealth can lead beginners to underestimate risk, overtrade, and make impulsive decisions. While the dream is alluring, it frequently blinds traders to the discipline, knowledge, and patience required to survive and thrive in one of the world's most challenging markets. While the dream of day trading promises fast profits, the reality of the US market is far less forgiving. The market is highly competitive, with institutional investors, hedge funds, and high-frequency trading algorithms dominating liquidity and price movements. These players have access to vast resources, advanced analytics, and technology that far surpass what most individual traders can employ. As a result, retail traders are often reacting to moves already anticipated or triggered by more sophisticated participants. Volatility, which many beginners see as an opportunity, can quickly turn against them. Rapid price swings may create the illusion of easy profit, but they also magnify losses. Even a small misstep in timing or execution can wipe out a day's gains or more. Additionally, transaction costs, taxes, and regulatory requirements can erode potential profits, making consistent success even more difficult. Psychology compounds the challenge. Fear, greed, and overconfidence often lead traders to deviate from their plans, chasing quick wins or holding losing positions too long. The combination of market structure, competition, and human emotion creates an environment where most day traders struggle not just to thrive, but even to break even consistently. One of the biggest obstacles for day traders is not the market itself, but the human mind. Trading demands discipline, patience, and emotional control, qualities that are often tested to the extreme in fast-moving markets. Fear and greed, two of the most powerful emotions in trading, can easily override logic and strategy. A promising trade can be abandoned too early out of fear, or a losing position can be held too long in the hope of a rebound, amplifying losses. Overconfidence is another psychological pitfall. Early wins can create the illusion of skill, leading traders to take bigger risks or overtrade. Conversely, a string of losses may trigger self-doubt, hesitation, or impulsive attempts to make it back, disrupting a planned strategy. Many beginners underestimate how much mental toughness is required to stick to rules, manage risk, and maintain consistency under pressure. Discipline, however, is learnable. Successful traders develop routines, set strict entry and exit rules, and treat losses as part of the process rather than personal failures. Without this structured approach, even the best strategies can fail. Psychology and discipline are inseparable in day trading. Mastering one without the other rarely leads to sustainable success. Many aspiring day traders overlook a critical reality. The market is not free. While commissions on trades have largely disappeared with many US brokerages, other costs and hidden fees can quietly erode profits. Spread differences, platform subscription fees, data feeds, and margin interest can add up quickly, especially for high-frequency traders who execute dozens or hundreds of trades daily. Leverage, often marketed as a tool to amplify gains, is another hidden trap. While it can magnify profits, it also multiplies losses, sometimes exceeding the initial investment. Beginners frequently underestimate the risks of trading on margin, leading to rapid account depletion. Additionally, patterns like overtrading or chasing volatile stocks can increase exposure to transaction costs and slippage, where trades are executed at worse than expected prices. Regulatory rules in the US market, such as the pattern day trader rule, impose further constraints. Traders who violate margin requirements or fail to maintain minimum balances may face account restrictions or forced liquidations. Ultimately, even a seemingly profitable strategy can fail if traders do not account for these costs and structural traps. Awareness, careful planning, and disciplined execution are essential to prevent fees and hidden risks from quietly destroying returns. Despite the overwhelming odds, some day traders do achieve consistent success, but they are the exception, not the rule. Winning in the US market requires far more than luck or following trending stocks. It demands experience, discipline, and a deep understanding of market behavior. Professional traders often develop detailed strategies, strict risk management rules, and emotional control before risking significant capital. Even then, success is measured differently from the popular perception of instant wealth. Many profitable traders aim for small, consistent gains, rather than attempting to hit home runs on every trade. They treat losses as inevitable, using them to refine strategy rather than as personal failures. Access to advanced tools, quality research, and fast execution systems also plays a critical role, creating an uneven playing field for retail participants. For most beginners, the reality is sobering. Only a small fraction of traders earn long-term profits. The majority fail because they underestimate risk, lack discipline, or overestimate their understanding of market dynamics. While winning is possible, it requires preparation, patience, and realistic expectations, qualities often overshadowed by the allure of overnight success. Success is possible, but it is rare and hard-earned. Day trading in the US market is often glamorized as a path to quick wealth, but the reality is far more challenging.
The market is dominated by sophisticated institutions and algorithms, making consistent profits difficult for retail traders. High volatility, rapid price swings, and hitting costs, such as fees, slippage, and margin interest, add additional pressure. Psychological factors like fear, greed, and overconfidence further complicate decision-making, often causing traders to deviate from their strategies. While a small percentage of traders do achieve long-term success, it requires rigorous discipline, well-tested strategies, strict risk management, and emotional resilience. The majority of beginners, however, underestimate the complexity of the market and the preparation needed, leading to losses rather than gains. Ultimately, day trading is not a shortcut to wealth. It is a high-risk endeavor that rewards experience, patience, and strategy over luck. Awareness of the obstacles is essential for anyone considering entering this demanding arena.